Welcome to the Real Estate Reserve Podcast with your hosts, Jason Balin and Ian Horowitz.
Just keep loving the theme music, baby.
Dude, I love the open every time, man. Like, I don't know, it gets me pumped.
Hey, everybody. What's going on? Jason at Harmony Bankers and Ian at Equity Warehouse. It is April 17th, a Friday. What do we do on Fridays? We do case studies. So a few things lined up for today. We are going to hop into a case study shortly on the BRRRR strategy. It's kind of an interesting way to say it, but a project that Ian, he bought, he renovated, he rented out, he refinanced, and then he repeated into his next deal. So we're going to dive into one of those. We've got some good pictures and images and HUDs and screenshots and things like that we're going to share with everybody in a second. But first, we're going to bring in Greg in a second. And the reason why is, and let me bring in Greg. What's up, Greg?
How's it going?
Not bad, not bad. So Ian will give you, I guess, a little bit rundown backstory, but it seems to me Greg's the first one that I personally know who has money in hand from this crazy Paycheck Protection Program.
Yeah, we got it last night.
Yeah, so Greg, I'll give Greg a quick intro. I know him through my other full-time job of being a firefighter. We have some mutual friends. Greg Pilate of Greg Pilate Furniture Makers. My understanding is you guys are a high-end furniture maker, do a lot of work for big institutional size, like apartment buildings, conference tables, those types of things. And you've been negatively affected. So first, if you could just give a quick rundown of what your company does, and then we'll jump into how the PPP worked out for you and how it's going to help your business.
Yeah, we build mostly custom commercial office furniture, some amenity furniture for big apartment buildings. We do, tables for breweries and things like that. The big ticket item is the custom conference table.
Right.
We're in the DC market, New York City, Philly, a lot of work in Texas, California, pretty much ship all over the US. We have 10, 11 employees. We're actually working on buying a second company right now and expanding through all of this, which is kind of nuts in its own.
Right.
But yeah, we got shut down, I think, on the 19th of March. We got shut down by the state.
Right. And just so everyone's clear, Greg's in Pennsylvania.
Yes.
So I guess your first course of action when this all happened was this: did the state have any programs that they were offering up right then and there?
The initial shutdown, there was pretty much nothing. It would close up. We'll get back to you essentially when we can. Right. I want to say it took about a week for CARES Act and things like that to start showing up. The state had a small $61 million program, which went fast, obviously. I mean, that went in like 5 hours, and that was
right.
Gone. So we applied for that 5 minutes after they opened the program. It took about a week after applying that we got an answer that, we're going to get the money. Now, we still haven't got funds, but we did sign all the documents on it. It's closed. We haven't seen anything out of that at this program.
So, and that's the state level stuff, correct?
That's a state level. That's a Pennsylvania.
Right.
So you're like a little industrial fund, threw a bunch of money in it because it had people that could disperse it, and said, okay, go through your county, and then through your county you can apply to the state.
Right. So, and then, so once all that happens, you were kind of forced to shut down. Nobody could really work in your shop. The next step was then to go apply for the PPP, and if you're willing to mention it, who your bank is and how that all worked out for you.
So I actually bank with two banks. I kind of always have. It helps us with the size, like the amount of revenue that we're doing. It really helps us out. So one of my banks is Wells Fargo, and the other bank is WSFS. We stand for service, I think is what they call themselves, or Wilmington Saving. I don't know. WSFS, local bank, Delaware, Pennsylvania bank. Those guys have been awesome. The small banks are knocking out of the park right now. So I applied on 4/1. We were supposed to be able to apply, but the program got backlogged. So I think it was 4/4, which was a Monday.
Right.
I put in an email to WSFS, and I had already had communication with them because we're very close with them, and an email into Wells Fargo. Our WSFS application took about half an hour to fill out, and within 15 minutes, it was approved. Done. We got a confirmation number. They told us how much money it was going to be, and they told us that the money was now put aside with the SBA. We're going to get it. It just they don't know when we're going to get it. So yesterday was the 16th. We got the DocuSign. We signed it, and within 10 minutes, the money was in our account.
Nice.
Wow.
At the same time, Wells Fargo finally answered the email that, hey, you can apply right as the program ran out of money. So the big banks, my experience, the little banks are the ones getting this done. The big guys are done.
Yeah, 12 days later, same thing for us. I literally sitting here, and I'm not trying to be rude, but I am watching my email, and I just got an email from our bank that says our funds have now been deposited into your account. So it does seem like the small banks are the ones that are on top of it. And I think we all know since day one that Bank of America, Wells Fargo, those type of guys, they're getting their butts whooped. So
Wait, that just happening? That's a real life story.
Right here.
Nice.
Yeah. So we were taught, and we were talking about this earlier, and whoever's watching or listening, don't worry, we're going to get into this case study of the in a second, because I know that's what a lot of people are interested in. But we were talking about this earlier, and it's kind of an unfortunate mess just in general, right? Because I agree with you that the local banks are easier to do than the bigger banks, just because you can have personalized service and you can talk to someone, you can ask questions and things like that. But the unfortunate part is, I think everyone who has an approval already should be fined related to funding. I'm guessing I don't know this for a fact, but I'm guessing.
That's what we were told. WSFS told us that if you got an application form back that said your application has been accepted, even though they ran out of money, you are part of that program. Yep. It's just a matter of getting you the funds.
Exactly. That's what we figured. Yeah. That's kind of what we figured as well through the approval. But, it's super unfortunate for everybody who had to wait until last Friday to take, because none of them are, unfortunately, none of them are going to happen. So, and that's the majority, at least in our space, in the real estate investing space, the single real estate agent or, small brokerage or real estate investor or real estate appraiser, or somebody who doesn't have payroll, but they are 1099, they are an independent contractor. That's the super unfortunate part, because they didn't even have the time to do it. The funds were even, ran out. So who knows? And the thing is this, hopefully they're going to put together another stimulus package. I'm not sure if that is or not going to happen. I mean, there's a lot of signs now that's stating they don't want to, there's parties that they're fighting that, but I guess we'll see what happens on all this, and it's an ever-changing thing. The good news is at least some people are getting funds in hand, because until Ian mentioned that you had gotten money in hand, we didn't know of anybody.
Yeah. And actually, one question I do have, Greg, I don't know what they told you. I know that you're still technically shut down by the state. However, the funding is to put employees back to work. How are you going to navigate that, just for anybody else that's going through the same thing, where they've been funded, but they don't know how to get their employees back to work?
Well, you have to start dispersing the money when you get it. So you got it on a Thursday night. It made no sense for me to start payroll back up on a Friday. It would just be a nightmare, especially with coinciding with all their unemployment. So we're starting back on Monday. Yeah, we're still closed. It's essentially federal government unemployment in state. That's essentially what this is. And look, my hope is that we can get back open soon enough that now that money is being used for my production, because that's actually going to benefit the company's bottom line. But for me, my take on it, and I might be just a little different than some, my team was kind of hard to put together. It's a very unique skill set that you just can't pick up on the street. You either have to apprentice, go to a trade school, whatever. It's not the most widely, job out there, furniture making, especially in what we do. There's just not a lot of us. The biggest hit for me isn't revenue. It would be losing these guys and girls. because I can't just put a hire sign out, get these guys back, or replace with someone. I'm out of the game. I'm done. My market expect a certain level of work. So for us, this is huge because we guarantee another 8 weeks that we've got a team, whether they're working or not.
It's the same thing.
We open.
Yeah, and it's the same thing for us in real estate. We all have our guys that, whether they're 1099 or they're employees, that guys that are plumbers or tradesmen or whatever that are looking for work. And granted, a lot of them aren't jumping somewhere else to go to work because there's really nowhere to go. But it's the same type of thing that, hey, we're trying to keep these guys on the books, and we all build teams over the years, so we feel your pain. I know. I'm sorry, Jay. You got anything else?
No, that's the long and short of it. It's the big takeaway that I got from it is just don't give up. I know the funding ran out. The funding also ran out for the EIDL. Supposedly, if you were in for the EIDL, you're supposed to get it, but I haven't heard anything on the EIDL. That's a mess. But keep watching the news. I can't say that they're going to fund it again, but the amount of people that have not gotten funding, I don't see them not funding it again. I think they're going to have to. I think it's time. Keep on it and keep, don't be a jerk, but put the pressure on who you're working with. Explain who you're working with. Look, I know everybody's in trouble, but get me on the list. Get me going here. You just have to be a little bit more forceful than maybe we're all a little bit used to.
And I think that's why the small banks were the advantage. Like I know our bank, People's Bank, they're up in Lancaster, and all around PA, but they literally told us that everybody that is a banker or works for this company is actively pursuing the PPP loans for all of our clients. Because, it's a smart move. They know that small businesses, help them turn a lot of money through their banks. So, and
that's the thing to remember. Some of these people that are processing these loans, they're not loan officers. They're bank tellers. So when we even got ours, they asked me, hey, can you tell us how the process went? Because you're one of the first ones. So they wanted feedback from us to even know how, because they don't know. I mean, this is uncharted waters for them. So, be respectful, understand that it's not that, they're in trouble too, but be thoughtful with it. The last thing I'll say, it goes down to, like you're talking about, the community banks, the small banks. I think a lot of people have learned a lesson about how important it is to have that relationship with your banker, because I did get a note from my SBA guy that we were in the first 5 businesses at that bank that got their application in. And it's because we have an existing relationship. We talk once a month. We meet once a month. We just go over what we're doing. It's all about relationships. Develop your relationship. Wells Fargo is great. Bank of America is great, but you're not going to get one-on-one. There's going to be value with these small guys.
They're not. Agreed. All right. Well, we certainly appreciate you hopping on and sharing those insights with everybody. We certainly appreciate it.
Yeah, take it easy.
All right, take care. Yep, you too. Thanks.
Thanks, Greg.
All right, cool. Yeah, no, that's great information, and I'm glad that we were able to bring him on to give everybody some insight from somebody who actually got funding. All right,
and real quick, if you didn't get to see, or I know we didn't let him leave his contact info, but if you guys want to see some cool furniture, I know he did all the furniture work down at the Guinness Brewery. It's Greg Pilate Furniture Makers. He has a Facebook, and he's everywhere else online. So
comment that below this video, Greg. If you're still listening, throw that on the comment section of this, and we'll share it out. All right, so let's hop into your project, Ian, that you had done. What you want me to screen share?
Yeah, let's pull up the Google image, and let's start here. So this property was brought to us along with a few other properties, and like Greg was just talking about, is relationships. So this property here, 4343 Garland Avenue, was brought to us from a wholesaler. Most of you know the wholesaler. My buddy Terry Royce.
It's the one. This is the special. I forgot to mention this earlier. Dang it! This is the special edition Terry Royce shirt. So we obviously have a lot of. Sorry to interrupt, Ian. We've got obviously a ton of different HMB style shirts that we've made over the years for all of our clients. So when all of our clients do loans, we send them a special edition HMB shirt, or we send them an HMB shirt. We've got maybe 20 different 20 different versions. And Terry's like, won't you ever make anything orange? And not that I think this Maryland logo would look great on orange, which it doesn't, but we decided to make a special edition one for Terry. I think we only made 5 of them. So I have 1 of them, and then I shipped out 4 to him. So you're welcome, Terry. Anyways, go ahead.
I think he wears it all the time. But either way, Terry brought us this deal. I think a buyer had backed out on him, along with a few other properties. We were actively buying at that time. So we jumped all over this. The interesting thing about this property, I don't know why I'm frozen up here. So this property is in Nottingham, Maryland. So like where Bel Air Road and Silver Spring meet up. It's only this one half of the house. It's these 2 windows, Jay. I'm not seeing any live comments if anyone's commenting. But this half of the house, and it's not letting me scroll forward. Oh, wait, there we go. So you guys can see, it's actually a 3-bedroom, 2-bath house with 2 full baths, with a finished basement that we turned into a 4th bedroom. Now, when we originally originally bought this property, our goal was to go in here. We knew it was an opportunity area for a local program called BRRRR. They look for properties that are in certain neighborhoods, certain zip codes, and certain census tracts for their tenants to move, and they will pay a little bit above market rent. So we knew at 3 bedrooms, this thing would rent at $1,800, and if we could finish the basement, that it would rent at $2,200. But our goal, our business model is never, ever, ever finish basements unless it's well worth it. A $400 swing was 100% worth it. So going into it, our expectation was only to keep this as a 3-bedroom property. Plus doing that, we also knew our renovation costs. This is a newer house, that it would be a little bit less. If we so then choose, and we knew that the basement was dry, the basement had no issues, we could go in there and finish the basement out for, an extra 5 or 10 grand. I'm trying to remember how bad the basement was, but either way, we knew for a few extra bucks that we could get in there and finish it up. Another big thing about this is we don't usually buy houses at this price point. It's a little bit above where we normally are. The area is considerably nicer. We were a little bit worried about cash flow, but we knew our disposition. We knew how to get the property rented. We knew that we could get the property refinanced. So those were 2 major things that kind of made us really willing to buy this. The other thing is we did confirm it from our tenant placement person, who said, hey, by the way, if you finish this out, you should hit the $2,200 range. So what we did from here is, once we got the property under contract, it was a matter of financing it. So at that point, we reached out to Jason over at Hard Money Bankers, and said, hey, and said, hey, is this a deal? Is this a deal? And is seriously how it went down. We'll show you in a second, but is it a deal that you would do? So Jay, I don't know if you want to walk through like what your underwriting process was. We just real quick, our expectation of budget was, approximately 25 grand. But if you want to.
Yeah, I mean, deals like this, we love. I think most lenders love. And the reason why is they're in the suburbs. They're very, very easy to comp. They're still in the median housing price neighborhoods, which most hard money lenders like. The beauty of this one is you can flip it or you can rent it. And you would typically do similar types of renovation budgets for both, give or take, all around. It's just a good type of asset. It's hard to lose on a deal like this if you buy it at a good price. And as a lender, if you're lending around 65%, give or take, of it, I think we might have got a little bit aggressive with Ian. I think maybe like 67% or something we lent them on this particular deal based on relationship and based on knowing the area really well and comfortable with it, not a huge construction project, things like that. It made a lot of sense.
Yeah. And so, again, back for us, I think we were paying $140 for this. It's just not our normal business model. Sure, deals like this come through that everyone says, I just want a lipstick deal. And it's very few and far between, because lipstick deals, while they sound good, they're actually kind of harder to do. We prefer to find houses that you can literally walk in the basement, look up, and see the sun, right? Like that's our go-to, because we know everything that we're putting back into it. So the deal in our eyes was a little difficult. So as Jason said, after a bunch of back and forth, we finally agreed to terms, which basically he told me what it was and I said, okay. But our expectation was, I think we paid one. Let's see. Let's go over here. So, do you want to work? I don't even know if anybody can see it if it's too small. But I think we wound up paying 140 after we paid the wholesaler's fee and all our other good costs to get the deal done. So there's the HUD. Here's our accounting side of things. You know, we got a loan from hard money bankers at 150. We brought 15 grand to the table. A little note, if anybody can actually see this, you know, our expected budget.
I think you froze up, Ian. Ian, you froze up? Hold on. I think Ian's computer froze up. Oh well. Ian, restart your computer because I think it. I think it's.
Yeah, there we
go.
We're back. I don't know. Yeah, they're working on the internet. They're putting in new cables outside. I've noticed the past few days. I've had trouble here the last 2 days, so I apologize. But I was trying to tell everybody, look, we make mistakes too. Not mistakes, you know, it happens. Our expected renovation budget was 25 grand. And you can see what we paid before the wholesale fee and what we paid after the wholesale fee. And what I was telling you guys is that I am more than happy to walk you through exactly what happened. So this property here, we wound up having to renovate it. We put new roof, new kitchen, new bath, painted it. The nice thing is we didn't have to do mechanicals. I think it was built 1970 something. It had a brand new HVAC system in it. So a lot of that stuff was squared away. So it was really just getting it cleaned up, getting it lipstick back together, and renovating the basement. So what happened was we got all that done, and then we got it leased out, and we went to go refinance it. And I just want to show everybody here, we refinanced this along. Of course, you're not going to work right now. Everything's freezing on me, boys. So when we went to go refinance it, we refinanced it along with a few other properties. I'm thinking my computer's. It's time for me to order. I got to stop working off the Mac. It's just a laptop. I don't know if it's powerful enough. I think it's time for a camera on my big computer and just do it that way.
On your desktop?
So, yeah. So either way, we did a blanket loan across, I think it was 7 properties. I think we got an $825,000 loan. And as you guys can see right down here on Garland, which way am I going? Where are you, Garland? 40. Where are you? Right here, Garland. We wound up, dude, it's not moving. I'm about to bail. Right here, we wound up spending $193,000.52. So our loan was for $150. We brought 14 to the table. That was $155. We wound up spending or 65. We wound up spending an additional 30 grand. Well, what did we spend it on? We spent it on fixing up the basement. We did have some holding costs of about 5 grand, interest payments and other things. The other problem is, you know, sometimes when you count on these things and you have two houses, we did this and another property right next to each other. Sometimes accounting can get a little difficult with the 2 properties being close to each other because the guy will go shop for both houses at the same time. So some of that cost overrun could be from that. So a lot of people talk about the BRRRR strategy and say, hey, y'all want to get all my money out, this, that, and the other thing. We tell everybody in our clients that come and, you know, do consulting with us is that it's okay to have money stuck in the deal. We've had plenty of deals where we've refinanced every single penny out, and we haven't had any money stuck in the deal. Well, your return at that point is infinite. Now, these 7 houses, we wound up having, of course, everything's backwards, but I think we wound up having right here, we had to bring $18,000 to the closing table to get this deal done. Well, who wouldn't do that against 7 properties, right? Like at that point, your cash in the deal is so minuscule comparatively speaking to what you're earning. You know, your returns, you know, 80% or 70% leverage. Like that's a home run all day. I mean, we were just talking about it yesterday with the multifamily guys. Their cash on cash returns that they're trying to achieve is 6.5%, and levered up, that's barely 10 or 12%. Maybe it's 15.
Yep.
So it's huge, and that's the power of utilizing other people's money. And I think there's a big push. It's like, we got to go get your capital. Jason, we bought this deal from Terry, right? I didn't go out and find the deal. Why am I going to waste my time? We're really good at construction and operating on the properties. We didn't go out and find the money. Jason's already got that established for us. So like, why do I need to go out and do all those things when somebody else that's really good at it? Let them go do those things and utilize what they have. Jason, I don't know if you have...
Well, if you're doing deals in volume, you have to do it your model. It's the only way to do it, because if not, the amount of employees that you're going to hire or the amount of time that you're going to put into it just isn't obviously worth it. If you're a one-off investor and you want to go try to raise private capital, if you want to, go out and do a bunch of marketing, if you want to be involved in every step of it, no problem, have at it to try to get a bigger return. But that being said, it just, time versus money, it just doesn't make sense. Like, there's no way, if you're doing whatever 10, 15 projects a year, that you can handle all of those all of those things over and over and over. It just doesn't work. So, well, let's talk about, so this is running for $2,200 a month.
Yep, 2,200.
Have you had much issues with this project, maintenance or anything like that after the fact?
No, Capex will. So, and that's the other thing, going back to our business model, is that, we do look to renovate everything on day one, because we reduce our Capex over the long term. I guess I should have dug a little bit deeper, and I could have showed you guys a spreadsheet that our Capex is not huge. Most of our maintenance calls is, a little bit of tenant damages here and then, just odds and ends. Anybody lives in your house, stuff's going to break. I think the worst thing that we've had happen there was that we had to replace something on the water heater. I think it was the electric going to it. We had to put a disconnect in because we had a fused one and we wanted a non-fused one because that fuse would continue to blow. Other than that, Capex wise, I'm going to jinx myself. She'll probably call me tomorrow and tell me something's completely wrong, but no, there's not much maintenance there, and when you look at, go ahead.
Yeah, it's also because you're doing a lot of heavy lifting on the front end. I mean, a lot of investors, the ones that want to do the lipstick on a pig projects, especially if they're holding them as rentals, it just comes to bite them down the road. They put less money in now, but then all of a sudden, instead of having a 10 or 15 year life expectancy on a roof or something else major, capital improvements, those things pop up, one by one. This year I got this, and then all of a sudden, you either put it in on the front end, or your maintenance costs on a monthly / yearly level are just astronomical, because you're just redoing stuff. And we ran into a whole bunch of rental properties that we own, and that's happened to us. It's a pain in the neck because we want to have a certain budget set aside for what's up, Rodney in Indiana? How are you? We wanted to set aside the right budget. What's the right budget that you have per property per month?
So I think Dan was alluding to it the other day. I believe that our budget for Capex is $50 a month per property, but that's based on our business model. And going off what you were just discussing, it's hard enough to renovate a property vacant, let alone renovating a property for a major Capex project with a tenant living there, right? So when you look at it, not only from that hassle, the other thing is that when you have downtimes, like, oh, I'm going to go do the roof, and I'm going to do this, I'm going to do that. Well, now you're losing 3 months of valuable rent. At least when you buy it, you're not earning anything. You have this expectation that I'm going to go fix everything on day one. We find a lot of investors that get in trouble are the ones that go in, buy the stuff, don't renovate it on day one, try to get away with it, and just cause themselves problems over the long term. So we budget $50 a month per property. We put that in a reserve account, and I know when Dan was on the show the other day, we were talking about, we ran into some trouble with turnover costs and stuff and not budgeting for it. But now what we do is we put $50 per property away in a reserve account. So if anything major happens, we draw off of that rather than just saying, well, it's coming out of our operating budget, We draw off of that. and then just refill it and stock it up. And then when it hits our max reserve number, then it's like, okay, well, that's additional cash flow that we can distribute or go buy other stuff. And that's how it takes a lot of discipline to do. But if you're willing to do it over the long term, it'll pay massive dividends back to you.
Yeah, you have to do it that way. It's the same thing we do with our lending portfolio for deals that potentially go into default or have unnecessary things that we have to do. Taking money out of your operating account absolutely sucks for anything that's unexpected. And our rentals, we have a higher reserve every month, and we also have less monthly cash flow because we, especially now that most of our rentals were purchased over 5 years ago, and we have the stuff that was improved. Some of that stuff is starting to run into issues, but more importantly, a lot of the stuff they weren't full renovations. So things are popping up regularly. It drives me absolutely crazy that they happen, but it's fine. I mean, we have a good enough reserve that we can cover it. So really all it is less positive monthly cash flow. But what do you guys look at? And Farrah, I'll answer your question real quick. Our interest rates at Hard Money Bankers are 13% when we lend out capital.
And real quick, let me comment on that a lot of people get scared off about that, but it's a cost of doing business, and we roll that cost into the cost basis of our property. Our account allows us to do it. So there are advantages going forward. That's a cost of doing business. Whether you get it from Hard Money Bankers or, you go out and ask your friends, look, man, they're taking a risk on something that they're expecting you to do. So we've always looked at it just as a cost of doing business, and that's it. So.
Yeah, well, thank you for supporting the cause.
I'm serious. It doesn't matter if it was you or anybody else. I would say the same exact thing.
And here's the thing: like, people hear 13%, and that's a sticker shock for a lot of people. Right. But guess what? That's annualized interest. So you divide that by 12, and that's what you pay monthly. So the payment's $1,082 for every $100,000 that you borrow per month. So if you only borrow the money for 3 months, $100,000 for 3 months, it's $1,082 a month. So a little over $3,000 to borrow $100,000. So, it's not bad. You want, Farrah, related to, do you have investment loans? Yeah, we absolutely do investment loans for apartment buildings, and up to what amount and what units. Don't really have a max. I mean, we try to max out around $2 million per loan. That's just our comfort level, but we're open to those. You want to answer Rodney's question? Take a look at that.
I've got 6 judgments that were foreclosure properties in Maryland for you guys. 3 are clear. 3 still started. Sounds good for you, man. You're cranking it out during the Corona era. People are still doing deals. I guess that's a good thing.
So you have the judgments. You're the judgment owner currently. Have you bought those judgments, or did you foreclose on them and then had the deficiency judgments that you have? Give us a little clarity of what you're looking for. I'd love to submit them and get started. So I'm guessing that somebody foreclosed on a property, and then I guess they sold you the judgments. Give me a little clarity on what you're looking for on those. That would be helpful. Okay. So where are we going at? Oh, so what is your target return cash flow? Let's first start of like how much you want to make monthly per unit, because I know a lot of people, they don't really care too much about their percentage return, because who cares really on a percentage return? Right. I don't care about that either. I want to care about dollar signs, and it's like, hey, great, I'm getting 100% rate of return if I put up $1 and get $1 back, whatever. But that doesn't mean anything. When you buy a property, what's the minimum amount of monthly you want back cash flow? Plus, obviously, you're analyzing these over interest rate return, and I get that.
Yeah. So for us, the simplest way when we initially got started was my metric. This is crazy, but was that if my mortgage was $600, that I was going to try to make $600 in cash flow. That was my goal. That's a super,
good metric.
That's a super hard metric to meet. You got to go into some, sketch areas to do it. Right. And then you really, your life, everything else it's worth. a little more, and you can only work in those neighborhoods for so long. So as we moved up, our goal is between $300 to $400 per month in net cash flow after the mortgage is paid. And people might say, well, that's low. Well, comparatively speaking, no, against the amount of capital we have, it's not. The other thing is we fix everything up on day one, so our Capex it's not hurt. All of our costs is rolled in up front. So that's our target, is between $300 and $400 based on where the area is. You start lower than that and think about it, $2,500 a year, you have one major thing go wrong, that money's wiped out. So it's not really, you're just kind of turning money. With that being said, that's where we're at. That's what our comfort level is for the areas that we invest in, which I would say are C plus, to B, is really where we like to be. So no, we got bad stuff. You know what I mean?
Yeah.
But our primary area is the Beltway. I mean, a lot of B stuff, a lot of workhorse, blue collar type areas, medium home, like you've been saying, medium home pricing. We will go into some other areas that we know are trending upwards, and we'll go buy the stuff that's a little bit tougher, but it's also a little bit tougher to get money on. So
those are considered median housing prices.
$150 is not median house pricing.
Yeah, those are, but that's not everything you got.
No, I was gonna say it's not everything we got. That's why I say C going up to B.
Most of our stuff's in the B minus B world. I would have I would like to upgrade a lot of those assets to get more into the B plus neighborhoods. We've had some conversations with a lot of people, especially the guys at Harborstone Advisors yesterday with their multifamily stuff, that their C stuff's running into a lot of issues right now. And we're only into this month one because the tenants are having a hard time paying. All their B and A stuff has been great. They've been collecting lots of rents as well. We haven't all of our stuff that's B minus or B. Now, granted, a lot of it's subsidized, so that it's hard to layer that in. But even the stuff that's not, we haven't had any issues yet with stuff that paying or not paying. Everyone's been paying so far. Now that's month one. April 1st was a huge test. May 1st is going to be the next big test. But I think in general, the C stuff is going to run into a little bit more problems with tenants and residents being able to pay. The B and A stuff will be obviously a little bit better. Now, again, that also depends on what part of the country that you're in. I'm just talking mostly here because that's where we obviously know the most, because that's where all of our portfolios are. But I would say, when we start buying some new rentals again, because most of our rentals were well over 5 years ago that we purchased them, and then we sat on those and had our portfolio kind of grow and mature and get better at them, because obviously a big part of this is everyone always wants to just buy instead of like analyzing exactly what you're doing. And when we had a few rentals, everything performed great. Then we bought a whole bunch of rentals, and then all of a sudden, the numbers didn't shake out to be all that great because you got to walk before you can run. A lot of people just want to ramp up without putting systems behind it. So we took a step back. We put systems and processes in place, so we're well stabilized, and that's been the last 5 years, and they've been great as well. But I think when we go and start buying more assets again in the future, we're going to be probably more B plus neighborhoods. And for us, the reason why is, I want less headaches, and with less headaches, I'm willing to take a smaller return and a less return. We have very good cash flow on a monthly basis. That being said, I'm not 100% sure that most of those properties have appreciated all that much. They have a little bit, but not all that much. And in general, I would like to have less headaches, a smaller return, deploy money in good assets. If you ask anybody who's owns a lot of assets and wealthy individuals, the goal with investing is you always want to up your asset class and invest in, bigger and better projects in general. You start with, maybe one house, and you sit with a rental, then maybe you sell it to a 1031 and invest in a bigger one, and then maybe a smaller multifamily, and then a bigger multifamily. So we'll see. And the good part is we can do 1031s with all those and defer any capital gains.
Right. And I think that's something that we found out very early on, is that,
thank you, Antoine.
is that when we were, flipping houses, we were in a certain neighborhood, and then we would go back to the other neighborhoods where we were renting out properties. Like, well, why don't we just do the properties where we're flipping houses? Like, if those houses are good for the flip, why wouldn't they be good rentals, right? So yeah, we've been moving up the asset classes as well. We've also done it through exploring in different asset class types. Going back to what Justin was saying, some of the C plus stuff that's not working versus what's working. I think this is the key to a lot of stuff right here. Having subsidized rentals and understanding that game, so you can get through and navigate processes like this. I mean, we've lucked out going through our portfolio. Almost 87% or 85%, somewhere in there, of our rent comes from the government. So as long as the government doesn't have any crazy shutdowns during all this, we've been pretty secure. We haven't seen anything crazy in the way of rent deficiencies. We did have one tenant push back, so that's not bad. 1 out of 100, it's not bad.
Yeah, I mean, obviously, a portion of them, not all of them, are just getting 100% subsidy. So you still have partial payments that are coming in from your residents that you're collecting on.
Yeah, we have a tenant,
which we do too.
Yeah, we have a tenant. She pays literally the whole rent. Her son moved in to help him out, and her income in the household was too high, so she's responsible for all $1,400. But the reason she remains on the program is that the voucher's in her name, and if her son's to move out, that she wouldn't be able to afford the rent, and it would change what her portion is. So either way, it works for us. It's all what your comfort level of it, is. You're sure you get into the B plus neighborhoods, and there's money to be made. There's money to be made in the A, but like Jay said, it's more, you start turning it into more of a savings account, and you're diminishing your return. So if you're looking for active cash flow, make sure you find something that works for you, you're comfortable with. And we always tell everybody, even though our houses might be in certain neighborhoods, that if I was single when I first got in the fire academy and we first started this, would I live there? That the quality of the housing's there. So whether it's an A or an F, it does not matter. Would you live there when you leave? That when you leave that property, you would live there. God forbid anything went wrong. So either way, that's what works for us. I'd be happy to talk to anybody else about it. If you'd like to learn more about what we do with the subsidy programs, we have written a book on it. It's a great way to diversify your portfolio. Landlordinglife.com.
Exactly.
Check it out.
Antoine, not doing any 1031s right now. I heard they were going to extend the time frame on those. I don't know if that actually ever happened during all this, between identifying the property and purchasing the next property. I'm guessing that they probably will if they haven't.
Have you ever heard of so there's the 1031 program, right? There's the Opportunity Zone program, which is something completely different to deferred capital gains. Have you ever heard of a monetized installment sale?
No. Explain
You've
that.
never heard of that? Okay, so
I don't know. Explain it. Maybe I've heard of something.
My understanding is
not that term.
Some big corporations utilize it. Say I went in and I bought a property off of you, and you wanted to defer your tax gains. What you would do is go to an intermediary, just like a 1031, and what they would do is they would take 5% or 7% off your proceeds, and they would give you a loan back. And essentially, you have this loan that's outstanding for the next 30 years, which ultimately defers your gains because you're taking it back in the form of a loan. It's not a seller carryback. You're getting your lump sum payment. I did some research on it. Some big corporations are utilizing it. It's not a very well-known strategy. I don't know anybody. I know one guy. I'm waiting to see if he actually completes it. He's selling a storage facility up in Ohio, and he said he's going that route. So if he does it, I would love to bring him on and discuss it with him.
Yeah. I got to think through that, not on the fly, and think about if that makes sense or not. Hey, when we get off this call, share that, and then we can share this on our next one as well. Share the realized passive losses.
Yes.
If that's real. I don't know if that's definitely real or not, but if that is, that's great. So what he's not claiming this, but what it looks like, and don't quote us on this because we haven't done enough due diligence, but this is good news if it is. Potentially you can realize all of your passive losses on this year's tax return if this is accurate. Because what happens is typically you have passive and active losses. And most real estate investors, if you're a full-time owner of real estate, if that's your full-time job, you're considered a full-time real estate professional. or investor, you have active losses, right? You have active gains and you have active losses. Now, if you're not that, for instance, I'm a full-time lender. I'm not a full-time real estate investor, but I own, a good amount of real estate. If we take a loss on a rental property, I don't get an active loss, dollar for dollar. I get a passive loss. And a passive loss is not great because, number one, in order to write off a passive loss, you need a passive gain to do so. So for instance, potentially if I sell a rental property at a big gain and then I have a big loss on a rental property, for instance, those could offset, so those could work. But typically, like, I'm not selling assets, so I don't have any gains to offset. So when it's passively, I think what can you do, like $2,000 a year or something that you can defer or that you can write off per year? Because what happens is with these passive losses is they keep accumulating, and then you write them off over a long period of time. So let's say you invest in a business, a startup or a business, and you take a loss, and you're like, okay, well, I took a $20,000 loss. At least I can write that loss off that I invested in this business. Well, you can't if it's a passive loss unless you have passive gains to do so. So there's some documents going back and forth, or there's some news articles going back and forth that all of your previous tallying passive losses can be realized this year on your tax returns. But again, that's not verified, so don't quote us on that. Yep. But if we find out it is and we're able to do so, that would be great.
Yep. And I was just trying to find it to read it word for word, but that was our understanding. So that's that. Hopefully this case study was helpful. I know next week we got a fully packed week. We have a new home builder, infill lot builder from PG County jumping on, Vernon Vaughn. I believe Tim Kane just confirmed with me. He does a lot of high-end renovations in the Arlington and DC area. So we're going to see how he's been coping with everything, and is an active real estate investor. And I'm sure that we have a case study lined up for next Friday. But
I've got some news. I got some bigger real estate agents that want to hop on with us as well. So we'll share their information with you as that happens to see what they're doing. Let me just run through a few of these real quick questions, and then go ahead. You want to?
No, I was just giving you some filler. That's my job as the other podcast host, just to fill in while you're reading. No, I was just going to say, it's been a jam-packed week, and I think we should do a recap tomorrow.
I'm cool. I like doing recaps on Saturdays. Yeah. Rodney, yes, I am familiar with all of the ones that you're talking about because that was like a year or so ago. Email me at jason@hardmoneybankers.com, jason@hardmoneybankers.com. Terry's aware of these, and I'm aware of them. I know you couldn't get title clean on these. They were all on like the other side of the Bay Bridge, so I'm familiar with them. What else did we have?
Someone said, good.
Farrah, yeah. We'll as we learn more and as we hear more, we'll get you some more info. Antoine, all of the calls that we do are on a few different places. You can go to the real estate realestatereservepodcast.com. I'll put that right here. Here's the link, realestatereservepodcast.com. Every day we go live on the Hard Money Bankers Facebook page, Ian's Equity Warehouse Facebook page, the Real Estate Investing Incubator Meetup Group, the Hard Money Bankers YouTube page, and we're in the process of going live on my personal LinkedIn page as well. So we're trying to make sure everyone has full access to all of this.
We're on iTunes, Stitcher, anywhere you listen to your podcast, they get downloaded, and usually that day or the next day that this episode, if you can't actually get in front of your computer and watch it, you'll be able to hear it on podcast as well.
Ronnie's question is, yes, we are still actively lending. We're a little bit more conservative than we were in the past, but we're still actively lending. Feel free to email me at jason@hardmoneybankers.com. Typically, just a little bit of brief synopsis of what you're looking for, and maybe the address of the property, purchase price, construction costs, things like that. And I can let you know very, very quickly exactly how much we can lend. We only lend in Maryland, Virginia, DC, and then we have an office in Pennsylvania where we lend in Pennsylvania, New Jersey, and Delaware. I would encourage everybody, if they are buying rental properties, to pick up Ian's book, Subsidized. Obviously the purpose of this podcast is not to sell anything. We're not gurus. We're local investors doing deals like you guys. And that's always been the thing. We're never going to bring on anybody here that's trying to sell anything. That's not what it's about. But Ian did have a really good book that he did called Subsidized. So check that out.
And I would like to say before we roll out is that next week should be interesting because it sounds like a lot of areas are starting to open back up. And it should be interesting to see how people are mitigating everything as things reopen. So it should be a real interesting week next week. So definitely stay tuned. And we will have new investors, new real estate agents, lender, whoever. If you have pertinent information you want to jump on here and get interviewed, come on. We're always happy to have anybody that's willing to talk about real estate.
Are you gonna upgrade your internet by next week?
I do. I'm watching them. They brought this machine in like a like a trencher or whatever, a missile thing, and they shot it, and then they put all the cable in, and now they're stretching all the cables. I don't know if that's what's affecting it.
Got it. I don't know why I had a zoomed in, zoomed out. I like to zoomed in better. View.
Yes, the book is on Amazon. You can look it up, Subsidized, or you can go to landlordinglife.com and you can pick up a copy of the book. Or if you go to Real Estate Reserve podcast, I believe both mine and Jason's books are both on there as well.
Yeah, I'll show you real quick while we're at it. Our two books that we have. We've got the whiteboard book, which was our original book that my partner Chris and I wrote for small business owners in general, not geared towards real estate, just small business. And then we had this book called Property Hackers that we released late last year. Your guide to becoming your own successful real estate investor. So, but yeah. All right. Well, hope everybody enjoyed. Thank you for watching. And we will see everybody. Maybe we'll do a show tomorrow. We'll see.
Yeah, we need to do a recap.
We might do a
busy
recap
week
tomorrow. If not, we'll do Monday. But yeah, I mean, we're all around. That's why we're just doing shows, doing deals. That's what we do.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too. Till next time, thank you for tuning in.